Okay, hello everyone. This is Alexandra Damsker. I'm here with another economics and markets live event. And I hope that it's actually streaming on LinkedIn and on X. I'm actually hoping this works. I'm trying to check and see if it's actually working on LinkedIn or live. If anyone is there, if you can actually send a comment to let me know that it's working on LinkedIn or live or X, to let me know that you're there. This is my first actual multi-stream, so we'll see how that works. And I'm actually going to try and invite a colleague to see if he's available also, because this is my first invitation also. So if everybody can just bear with me, hopefully you're all there. Setting this up was a little challenging today. I'm not really sure why, but we're gonna do the best we can. I appreciate your patience. Once again, Alexandra Damsker. This is another economics and markets discussion, and we're going to be talking all about the Fed. We're going to be talking about Kevin Warsh. We're going to be talking about some investment issues that you should be looking at as a result of the discussion we're about to have. And I'm going to try and welcome Joseph Silvia, who is the chair of the American Bar Association's Banking Committee, and another attorney. And we're going to get his thoughts on on Kevin Warsh and what he thinks about the Powell investigation and things like that. But let me actually see if I can get him in here. Let's see, invite guest, copy. Going to see if I can actually do this. I've never done this before. Can you tell? Here. Actually, just going to send it to his LinkedIn. For anybody who hasn't done this before, I'm going to encourage you to try it. But look, we all try new things, and this is how they work out. Okay, let me get to this. All right. So hopefully he'll be able to join. I sent him the invitation. Hopefully this works. Thank you everyone for joining. And given the time, I'm going to try and keep it in a close time constraint. However, so I'm going to get started right now. And knowing that I'm also trying to get someone else on here to give some commentary. I'm going to be doing that as well. So we're going to see how we do with multitasking. We'll see. And for all of the people who signed up, I hope you have a chance to get in here as quickly as possible. For those who are a bit delayed as well, I hope everybody, maybe can catch this, on a restream or something like that. But let's talk right now about the Fed. I want to talk about what the Fed does and what it is first, because you have no idea how much paper I have here right now, because I have done so much research on the Fed over time that I have more than a book's worth of documents here just on the Fed and its operations and its issues, because I have been looking at this for quite a long time. The Fed itself is an entity that people over and underestimate at the same time, and I have a stack of paper here that I've had for months and months and months that I've been using both for my newsletters and for various different discussions that I've had. They're so marked up, only I can actually decode these things, but they're very useful. And I think one of the biggest problems that we have is that most people, even people who work with the banking industry and with money and financial industry, don't really understand what the Fed is and how banks really use the Fed, and they don't quite understand exactly what power the Fed has, and how our money system works. And that is a big problem because first, it will impact how you are viewing your investment decisions. You have to know the value of the thing that you are putting into investments, right? The currency is the thing that you're putting into investments. And when you're seeing a lot of shifts in and out of certain assets, a lot of that is people who understand the value of the currency itself changing. The other thing is understanding what the changing value of currency is doing to other assets, right? So you need to understand how the US dollar is impacting all of these other assets. So we're going to talk a little bit about that. For my background, I'm a corporate and securities lawyer. I used to work at the SEC. I worked at a big firm, and I founded a couple of companies. I've exited. I've been working in blockchain since 2016, AI and quantum computing since 2019. I've been working in economics since I was in college, and like a very long time ago, and finance since I graduated from law school, and I've been offering education in these areas since around 2020. I've been just talking about this stuff, and the company that I am working with now, which is Populous, we do a lot of work with first and family wealth, and we do two main things. One is create community, because first and family wealth is excellent at a lot of things, but not a lot of people understand what that's like. I am also one of those people, and it's very difficult to be that kind of person. The other thing is creating opportunities for those people, because there are a lot of people that try to present you with opportunities, and they're not always actually opportunities. A lot of times they are things that get you into trouble. So that's what we're doing right now. We're just trying to protect the people that I have been trying to protect for years. So this is a real passion project for me, and something that's really exciting. I've got a team that's amazing, and I'm very excited about it. So anyway, moving on from there, let's talk about the Fed. First, you have to know what the Fed does and what it doesn't do. First, it deals with the flow of money, but it doesn't deal with spending. Spending is fiscal policy. Fiscal policy is entirely all about the Congress, right? Congress deals with spending. When we're spending too much, the deficits and things like that we have, none of that has to deal with the Fed. The Fed has to accommodate all of our spending policy, but it doesn't actually set our spending policy. It doesn't do any of that, right? So if you're upset about how money is spent, a lot of that is Congress. And some of the majority of how things are spent are not even debated annually in our budget, right? The majority of our money goes to two main projects, which is Medicare and Social Security. That's nearly half of our budget, and it is not actually doesn't include like the disability or people who need aid. It's actually just the retirees, and that's the majority, and it doesn't get debated at all. It's direct payment, so it comes out of your paycheck into someone else's. So anyway, you need to know about how budgets are made, but that stuff, not having enough money, that is all Congress. That is not the Fed. Right. So a lot of people think that the reason they don't have money or they don't like how the economy is working is because of the Fed. It's not the Fed. It's just easy to blame the Fed because they're not elected. But and that's what Congress loves to do, because Congress is elected. But the responsibility for the economy is generally, it's Congress, right? The state of the economy is Congress and the president to a large extent, right? But it is not the Fed, right? The Fed has to deal with the oh, hooray, Joseph's made it. I'm so excited. Welcome, Joseph. It's a pleasure to have you. And right now I'm going to, I just wanted to say, hooray, you made it. I'm very excited. And if you'll just give me a minute, I'm just going to actually, I wanted to make sure he could make it. But I'm just going to go through the rest of this before I bring him back to the stage. So just so that you know that, so Congress is the one that is dealing with the actual funding and the state of the economy. What does the Fed do? This part is important to know. Okay, how does the money flow through the system? First, when banks transfer money from one to another, they don't transfer directly. It all goes through the Fed. So if Bank A wants to transfer money to Bank B, all the banks have accounts, right, at the Fed. And so what happens is not Bank A is transferring to Bank B. All the banks hold their reserves at the Fed. And the Fed says that what they're really doing is the bank is saying, Bank A is saying, deduct this money from my account and credit it to Bank B's account. That's actually what's happening, because the banks aren't actually transferring the money between each other. What they are doing is transferring, they're transferring amounts in their accounts at the Fed from one to the other. That's what they're doing. Why do they keep their money at the Fed? What is the difference? If you guys remember, I think it was 2021, you used to have a certain percentage of money in reserve at the bank, right? It was like 20%, then it was 10%. That is not true anymore. There is no reserve banking. What happens now is banks keep any available cash at the Fed. Why? That money gets what's called the IORB, which is an interest rate that's paid by the Fed. The Fed encourages banks to keep money in reserve by paying them for it. Turns out that's a better system. It's better to encourage them with a carrot than to penalize them with a stick. So they keep money in reserve by getting paid whenever they keep money in reserve, right? So banks keep money in reserve, and that is the basis of liquidity in our system, is all of the banks keeping reserves, not in their vaults, right? Because remember, everything's digital now anyway, but the money is not kept in their vaults at their banks. The money is kept primarily at the Fed, right? So that's the first thing to know, is that the Fed basically uses that as that's the foundation of the liquidity. And there's another thing that it uses as liquidity, which is called the repo markets, repo and reverse repo. Repo means repurchase. So one of the things that the Fed does for liquidity, it's got three big pools. One is it gets tax dollars in, right? That's one thing that it uses for its bank statement, which you need to know, right? That it has a bank balance. It's got its own bank balance. It's general account, TGA, right? General account. It's got a bank balance, and it brings in money from basically tax dollars. It gets money off of some of the securities that it holds, which is, what securities does it hold? Treasuries, right? It used to hold mortgage-backed securities as well, but it stopped buying those. It doesn't hold those at all anymore. So, I mean, it might hold a few still, but it doesn't buy any anymore. It might actually still hold some, like old grandfathered in ones. But it earns interest on those when they expire, when they mature, or as they pay out, right? If they have coupons that pay regularly, then it earns money on those. It earns interest payments on those, because those are bonds. Bonds are just debt. Debt means you pay, right? Like a loan. It's just a loan, right? And you get interest payments on loans when you are the lender. So the other thing that it does is it holds a bunch of cash reserves, right? Which are the bank's reserves, so it's not really theirs, right? It's holding it kind of in trust for all these banks. It represents the deposits of everyone else. And then what else does it have? It has access to this repo market. The repo market is an interesting, complex thing, and it's something that we all need to know more about because it is the source of a bunch of crises, right, that are coming up, that have existed and are continuing to come up and are important for people to know about. A repo market is basically how banks borrow and lend money to and from the Fed. If a bank needs money, it can do something where it loans the securities it has. What does it have? T-bills. It has mortgage-backed securities, but the Fed isn't buying those, so it can't lend those to the Fed, but it can lend the Treasury bills of various lengths, short-term, long-term. It lends those to the bank or to the Fed overnight in the repurchase market. It says, I'm going to loan this to you. And the Fed says, okay, here's some cash for you right now, right? I'm going to give you some cash. And the bank says, I'm going to, lend you this note. And then in the morning, the bank says, am I doing this? This is the banks borrow. Doing it backwards. No, the Fed buys securities from the bank. Right. Okay. I am doing this correctly. I'm like, is this reverse repo? No, it's repo. So the Fed buys the securities buys the bond from the bank. And the bank says, I'm going to buy that back from you in the morning. Right. So it's only overnight, and they get cash just for the evening. One of the biggest issues that we have is overdrafting. Guess who has a problem with liquidity during the day, right? Guess who has a problem with liquidity? Banks. Banks overdraft all the time. They borrow from the Fed all the time during the day. They have this thing called intercredit loans that happen many times during the day. It's not a huge problem if it's collateralized or if they repay it during the day. If they have an overdraft overnight, they get massive fines, right? So they don't want to have an overdraft overnight. So they use this sort of liquidity to make sure that they've got enough money so that they're not overdrawn overnight. Like too many people took money out, and so now they need to have more money to catch up with the money that was sent out. And they're doing their accounting many times during the day, and they're like, oh crap, I don't have enough money. So they have to say, oh, I got to go get some money. And so they say, I've got some securities. I'm gonna sell them to you, Fed. I'm gonna buy them right back, but I need money so that I don't get stuck with this bill. Wouldn't it be nice if the Fed did that for us? Like, I want some overnight liquidity. Anyway, we don't get that advantage. That is for that's interestingly so only banks get the advantage of this repo market. Now, this repo market does a really big thing, which is set a ceiling on short-term rates. Essentially, for borrowers always know that they can get the price, the loan price that the Fed will give them, right? So if everybody's lending rate is really high, then they're always just going to go to the Fed, right? Banks are always just going to run to the Fed. If everybody's lending rate is super high, then they always know that at the last resort, they can run to the Fed. So that's how it sets a ceiling on the short-term lending rate, right? And that ceiling is something you may have heard of before, the discount window. And this is something that is set by all of the banks and the Fed governors. And all of this stuff that I'm telling you right now these are all the things that when the Fed says, here's the range, like we got a range on the 28th, the Fed Open Market Committee said the range is, let me see what it was, 3.5 to 3.75. What does that range even mean? This is what it means. There's a whole bunch of different rates that are set, and these rates all impact short-term lending. So one of the points to remember about this is when you hear about rates, interest rates primarily impact short-term lending. Short-term lending, right? Everybody thinks that it's primarily hitting long-term lending, short-term lending. So when you think of short-term lending, you want to think ease of access for credit for working capital for businesses, that kind of thing, right? That's the kind of short-term lending we're talking about. Short-term lending is different from the long-term lending that they use in their balance sheets, which is the next thing we're going to talk about. These are two different things. People focus so much on the interest rates, but those are strictly short-term rates, right? That's just like working capital rates. Those are not the long-term rates that really impact things like mortgages and things like that, long-term loans that are over 12 months. Those are all impacted by the balance sheets. And how many of you are even thinking about what they're doing with the balance sheets or understand what ample holdings really means? Right? That's what we have to talk about next, because that's really impacting the long-term rates and what you see in terms of, whether or not, people are going to start selling homes anytime soon, or people are going to start buying more real estate or things like that, or people are going to start buying cars, or is there going to be more building in your area in terms of facilities? Right? PPE, right? That kind of stuff for companies, things like that, which is the property and equipment and production. I always forget that second P. Property, something, and equipment. Property, production, and equipment. I'm not sure. But anyway, it's the hard assets that they're doing. That stuff also, that depends a lot on what the long-term loan rates are. So to understand whether or not a company can expand in the future, that you need to understand the long-term rates. To understand if someone can pay their payroll in the short term, that is the short-term rates, right? That's what we're talking about here. So we understand now that there's a repo where companies can, or banks can get cash. Then there's a reverse repo where companies essentially will buy treasuries from the Fed and then sell them back in the morning. Now, why are we giving the Fed money, right? What are we doing to give the Fed the money? Well, that is because we get more money. The banks all get more money. They get paid to sell their treasuries to the Fed. Right? They get also when they are borrowing the treasuries from the Fed, right? They're why are they giving cash to the Fed? Because the Fed needs cash. Why does the Fed need cash? The Fed has no cash. What's wrong with the cash at the Fed? What happens to the cash at the Fed? Too much demand, right? Too much demand on the Fed. Why is there too much demand on the Fed liquidity? What is the requirement for this liquidity, right? There's a lot of demand on liquidity. What would happen to require the liquidity here? What is the reason that people would put their money into this reverse repo thing? First, let's think about who puts their assets into the reverse repo market, which is also called ONRPP. Right, on RPP. If you've heard about that, that's also the reverse repo market, and a bunch of entities, not just banks, get to access this market. They get to park their securities in this market and earn a return. Now, why do they get to park their securities and earn a return? Because they get a guaranteed return from their securities here. It's basically they get they get it's a little higher than the interest rate for banks parking their cash, right? It's always set a little bit higher, like around 10% higher than what banks get for parking their cash there. So you get to you park your interest, your securities there, and you get a return. It's a safe place to park your assets. So the big money market funds park their assets there. A lot of the government organizations will park their assets there. Tons of organizations will park their assets there. Tether parks their assets there. Lots of organizations, they're one of the biggest holders of treasuries, by the way. They park their assets there. And in return, right, the Fed agrees. So for that, then the Fed agrees. So they're selling those securities, and the Fed agrees to purchase the securities the next day. So it decreases the reserves in the system, and it acts as a floor for the short-term rates, because there is no incentive to lend at a lower rate. Or sorry, to lend at a there's no incentive to lend at no incentive to lend at a lower rate. I'm sorry, I'm having trouble even reading what I'm writing here. Okay, so there's no incentive to lend at a lower rate. So if you can see, these two things set a ceiling and a floor on short-term rates. They also dictate a lot of the liquidity that's in the system. The Fed can generate liquidity from these two markets, right? They can generate cash, and they can pay out cash from this system, right? They can put cash into the economy, and they can pull cash out of the economy through this system. So these are really important systems, and they're a huge part of how liquidity flows into our system. Now, every time there's a huge payment that's required by a lot of people, and it's kind of what we call like the Super Bowl flush. I don't know if you guys know about this, but like a lot of people in the US, there's a big thing around like water systems, right? They have to be prepared on the Super Bowl, like for halftime. There's apparently a massive drain on our sewage system because everybody goes to the bathroom right at the start of the halftime. And it's called the Super Bowl flush, and it's actually a huge impact on our sewage system and our water system. Like it's like, don't take a shower at that period of time, because it's the impact is actually enormous. So anyway, when there is a massive payment requirement uniformly in the system, one of the problems that we have is that money comes out of the Fed system, and there isn't liquidity that is available for other things, for the Fed to pay interest, for the Fed for the Fed or dealer banks to buy bonds that are now out on the market, for it to do whatever it needs to do. When do those things happen? Tax day, things like that. When everybody is draining out, also the end of the fiscal year, right? Everybody's pulling money out and dispensing it to other people. It'll come back into the system as other people like deposit into their accounts, but sometimes they don't get deposited into US banks, and that money leaves the system. So the issue is what happens at those periods of time when there's no liquidity in the system. We have problems, right? So liquidity is one of the biggest issues that we have. It's a giant issue. So I know that this has taken quite a bit of time, because it's a really complex topic, but I do want to talk really quickly about liquidity crises. And I talked about this more extensively in one of my newsletters. So it's actually like, if you're really interested in finding out about the liquidity crisis, the upcoming liquidity crises, and how we should deal with them, this is something that, going to my my newsletter is the Damsker report on Substack, and that is, how you can find this stuff. But the way that these happen is essentially reserves get drained. How do they get drained? The Fed is buying a bunch of securities, right? A bunch of people put securities or selling securities to the Fed, and the reserves come out of the system, right? That's one way that reserves get sucked out of our system. Another problem happens. We have a lot of debt, and we have to fund more than debt. We have deficits in our budget. A third of our budget is funded by issuing new debt, right? So we don't have the money in our system to fund a third of our budget every year. So what this means is every year, a bunch of new debt comes out and has to be purchased, right? Who purchases the debt that's issued? The Fed, but also, right, the Fed will purchase it if they're in a period of purchasing. That's the balance sheet perspective. 1 second on that one. If they don't purchase, even if they do, but they don't purchase all of it, who purchases it? 24 dealer banks. What happens with these 24 dealer banks? They have to purchase anything that isn't purchased by other people. So if there's no demand for our debt, then these 24 dealer banks are required to purchase all of our debt. What's the problem with that? There's a regulation on the books that limits their balance sheet to a certain percentage of debt. And the problem with that is that most of their balance sheet ends up getting sucked up by having to purchase this debt. And they view the regulation views the treasury bills that are on its balance sheet the same as corporate debt, which is far riskier, right? So treasury bills, which is debt, is considered risk-free, but the regulation considers it as risky as corporate debt. So they have to limit their risk, and so they're only allowed to have a certain amount of debt. And so these banks are tied in how much they can buy of the bonds, but also what they can do after they buy these bonds. They've basically like clogged up all of their balance sheets with these bonds, and then they can't do much of anything. So it's a really bad system, particularly when there's no demand. Why would there be no demand? Two problems. There is currently a de-dollarization issue happening right now, right? Many countries that used to buy all of our dollars because it underpinned their economies, right? Many of these countries that bought a lot of dollars, they bought our debt, right? They didn't buy like actual dollars. What they did is buy our debt, which represents dollars. They bought our bonds that represented dollars, and it underpinned their economy. So it was foreign reserves to their economy. And a lot of them have decided for several reasons that they don't want to do that either in as great a capacity as they used to or at all. So they've been selling, which means that our bonds that we're selling on our market are now competing with their sales, and they're not buying ours. So we have that problem. The other problem is the value of the dollar has been declining. And it had a little bit of an uptick when Warsh was nominated, but it's plummeting again, right? So the problem that we have is when the value of the dollar is dropping, the value of our bonds is dropping as well. Now the yield is going up because if you remember, with bonds, it has a yield and which is the interest rate you pay, and a price, how much you pay for that bond, right? When the price goes down, the yield goes up. when the price goes up, the yield goes down. They are inversely proportionate. They're inversely related, right? So when there's a lot of bonds available, the price goes down. That makes the yield go up to make them more enticing. The problem is that also makes them way more expensive. When there's not a lot of them, or they're special, right? They're a particular bond that people really want, then the price goes up and the yield goes down because you don't have to pay that much for something people want. So that's what's happening right now, is that bond yields are rising significantly. What does bond yield rising mean? Well, the price has been dropping because there's a lot out there and people don't want them. That's a problem, right? That's a big problem. That means that these banks are overloaded. And what do we have about the Fed? Is the Fed buying these, the bonds? They are not. This is part of their current stance on ending their purchase of securities. This is the second thing. Somebody is talking about the repo thing. Okay. Anything. So one of the things to remember about the Fed, right, is the Fed has two ways of checking the market, right? It can deal with interest rates and it deals with its balance sheet. Interest rates affect short-term interest rates. The balance sheet affects long-term interest rates and the economy overall, really. The balance sheet impacts everything. But the balance sheet is what most people don't even understand. The balance sheet issue is really, or how much money does the Fed want to hold in reserve? How much money are they requiring themselves to hold in assets and reserves? If they have a lot of money in assets and reserves, then then the problem is, well, there's a few problems. One is that there's not a lot of money circulating. The other problem is they can have a vested interest in some of the market dynamics. So I have actually something more on this here. Okay, with a larger balance sheet, the interest expense on the reserves gets high, right? Because they're saving all of they're keeping all of the reserves from all these banks, and they have to pay interest on all of that. And the other thing is they might be intervening in the markets, which is they're hoarding cash. The other thing is that if they want to boost the economy by buying things, right? By buying assets, right? By putting more money into the economy, there is a theory that it makes this less useful because they've already got all this money in the system. I don't know how true that is, because we don't have a lot of experience with this, with our history of ample reserves, which is what we call this, ample reserves. With a low balance sheet, the problem is we don't have enough money when Bank A needs to transfer to Bank B. There's not enough money to make that transfer. That's the problem, right? What happens if we run out of money, if the Fed doesn't have enough money to continue its operations? There isn't really a rule. We haven't found the perfect amount. Right now, it's between 10 and 12% of the money in the system is what we hold in reserves. Is that the right amount? We don't know. But then we can get to Warsh and his view. But right now, the current, it's 10 to 12% of GDP. That's what we hold in reserves. But the issue right now is how do we make sure that that we don't run into liquidity crises? Because right now we continually have these liquidity crises, And one of the big problems, one of the things that we see are things that are called delivery fails. Now, I don't want to get too much more into this because I want to move into Warsh, but there's a lot to talk about in terms of the Fed. But the thing to know is that the balance sheet is going to give you the information whether or not they're going to buy treasury, right? Or not, buy T-bills or not, buy debt or not. That tells you whether or not they're doing quantitative easing or tightening. Quantitative easing is they are buying treasury bills and pushing money into the economy. Quantitative tightening on the balance sheet means they're just letting the bonds that they have mature and they're not buying more. That's what it looks like on the balance sheet. The interest rate that they deal with, remember, that's just short-term rates. That's setting a range for banks to do a variety of things, and that deals with working capital and short-term rates. The long-term rates, that is going to deal with the balance sheet, and that is really going to deal with whether or not there's going to be a lot of money circulating in the system or not, right? So, okay, talk about quantitative easing way more. I have a lot more on it, but I do want to talk about Warsh. So at this point, I want to move into this, the discussion of Warsh and a few things that are going on with it. So Kevin Warsh was nominated as the replacement for Powell. The reason Powell is going to be replaced theoretically, and I know that there's a lot more to talk about on the Fed, and I feel like I should have a whole other discussion on the Fed. It's such a complex topic, but you can see that the bank is not a simple thing, right? It is a complex piece of machinery that doesn't do. It's not like one button. People think it's like one button. It's just one interest rate and that governs everything. It's not at all like that. It's a lot of moving parts. And there's a lot of pressure on this one person, this one, the chair that is like the magical wizard. And it's weird that there's a magical wizard. Who thinks a magical wizard has that much power over anything? Like, it's weird that we even care. I think Greenspan is maybe the first person that anybody even like wrote about or talked about outside of like, Fed and financial circles. It's a strange thing that people are even talking about. Fed and financial circles are talking about this sort of, the head, as if that person has so much more power because that's just a vote, right? And he's the presenter, but isn't necessarily the person that is dictating any of these policies. And the issue right now with Powell is this lawsuit. There is a lawsuit right now that's happening that the government has issued a lawsuit against Powell for this renovation of the Fed, which was self-funded. So the Fed funds this renovation. It wasn't paid for by tax dollars, but it's a criminal investigation because the allegation is that Powell specifically lied to Congress about several things regarding the renovation. And then the reason it impacts taxpayers is because any money spent from the Fed that isn't spent correctly, right? It still comes from the TGA account, the Treasury General account. And that money that was spent, if it was spent improperly, it could have been spent to reduce the deficit or to deal with, taxpayer issues. So it was malappropriated. So the big issue here is that the Senate Banking Committee is deadlocked and will block Kevin Warsh's appointment until, this is what Tom Tillis says, the Republican senator has declared that he will block it until this criminal investigation is fully played out, which should be, I guess, the end of April. He will block the Kevin Warsh's appointment or his appointment and confirmation. He will block it from even reaching the Senate floor. He is extremely angry for what he says is not asking the adults in the room and for trying to bring this to a criminal investigation and for damaging the Fed's independence, which Trump says the Fed is theoretically an independent agency. And Tom Tillis apparently, from his interview, takes extreme umbrage at that and has issues with the with that language. And so Kevin Warsh's appointment or any appointment is on hold until this. Powell has said that this investigation is a personal attack for not lowering rates, and the Democratic like the Democratic senators in that committee apparently agree. So at this point, I want to bring in Joseph. Thank you so much for joining. A fellow lawyer deeply immersed in this, also runs a podcast called Money and Banking Law. And I would love to hear your thoughts on right now, just the investigation. And what do you think about the blocking? And do you think that, is Warsh even going to, like before the end of Congress, before the end of this session, is he even going to like come up for discussion?
Yeah, great question. It's great to be here. Thanks so much for having me, Alexandra. What an unusual time, right? I mean, this is just, I want to say this is unprecedented, but I'm not 100% sure that it is. It's pretty unique, at least from my perspective, in the short period of time that I've been practicing in the last 17 years or so, that we've seen an attack like this, or what appears to be an attack on Powell. And it just feels odd that this was the way to, in theory, deal with the fact that maybe the president wanted more rate cuts and wasn't getting them, or wasn't getting them fast enough. But that tension has now caused, I think, an even greater tension within Congress, with both the president and with Powell. And there's different party politics on each side, but now you really have a challenge of folks putting out perspectives like Tillis, right? That's his perspective, and I don't know him personally, but my guess is that he's not looking to go back on those perspectives and go back on that approach with respect to advancing Kevin Warsh's nomination, and even trying to protect what he thinks maybe is the independence of the Fed. I know there's been a ton of discussion about the independence of the Fed, and so at some point it becomes, I think, less so about the actual persons involved, less about Mr. Warsh, less about Mr. Powell, and more about how do we fundamentally want to think about the independence of the Fed, and how political are we going to view this going forward. So this is going to be a material impact. I don't know, to answer your question directly, I don't know that we'll see a real legitimate consideration of Kevin Warsh in the immediate term. I think people have dug their heels in, and whether that's good or bad from your own individual perspectives, it does frustrate the process a little bit. And again, it's, we look at the individuals involved in terms of Powell and Warsh and the president and Tillis and others. But I think at the end of the day, conceptually, it really is focused on what the independence of the Fed really means and what it should or ought to look like, based on the statutory construct act, based on all the things that you went through for the last 45 minutes, all the complexities of the Fed. This is not easy stuff. And so it is much more complicated than anybody really appreciates. So we'll see how it ends up playing out. I'm hopeful that, we get some clarity sooner rather than later on both the investigation and the consideration of Warsh. But as everyone is well aware, we do have midterms coming up quicker than we realize. And so at some point in the not too distant future, people in Congress are going to be focused more on themselves and running for re-election than they are on anybody else on the Hill.
What are your thoughts on the investigation? Do you think that there's a likelihood? I mean, I'm looking at the legal analysts versus like Polymarket. I think it's hysterical. But what are your thoughts on the investigation?
Yeah, I don't know that the investigation ends up going anywhere. It seems like there is a lot of gray space as far as I can see, as far as I've kind of read on it. A lot of gray space with respect to whether something was appropriate, inappropriate, who said what, when was the detail announced, was the spending really that far off from the expectations? What does it really look like, right? This is like arguing with your construction company or your builder when you're building the new house, and like, oh, I told you to save the marble on the wall and use it on the countertop, so I didn't have to pay the extra $10,000 for the marble countertop. There's so much detail, and I think I just don't see it really going anywhere significant. And unfortunately, it feels and it seems like it's a distraction more than it is really intense, long-term, legitimate investigation.
Yeah, I think it's funny that I found this interesting statistic that was like 90% of legal analysts are saying that this isn't, that there's not standing in this, there's not much substance to this, which is true. I mean, it's very, very difficult to take the testimony and turn it into, like a criminal outcome, right? That's a very high threshold. Yeah. But Polymarket, which I'm assuming you're familiar with, is that correct? Okay, so Polymarket has a criminal finding for Powell at around 70%, which just tells you how many lawyers are on Polymarket.
Yeah.
I think that's so funny. There's a question here. It says, please speak to how the political manipulation is currently affecting America's financial standing around the world. That's actually an interesting question. That what's the impact internationally? Like, are you seeing an international impact from this entire, soap opera that we're seeing here?
Yeah, so that's a good point and good question. From what I'm seeing and dealing with international clients, and especially in like areas like the digital asset space, this, what some are referring to as political manipulation, political chaos, whatever it might be. I think the word that keeps coming to me is uncertainty. And that's not what anybody really wants to hear, whether it's domestically or internationally. Nobody wants to see any kind of real political uncertainty or political upheaval in a place like the United States, which is just the global superpower with respect to the financial system. And so that, however these things are playing out, the pointing of fingers, the uncertainty on what the focus is on monetary policy and so forth, that is just creating more uncertainty on the international level. And so it's not good for really anyone, including the United States. But I think it's something that has to get kind of worked through. And even with the investigation, from what I remember, it was like early on, nobody was sure who actually said, DOJ, go investigate this, right? Like, I don't think there was ever anything that was supposedly came from President Trump. And so it was like, well, who at the DOJ decided that this was appropriate? But nobody knows, or nobody's saying, I should say. If somebody knows, but nobody's saying exactly who that individual was, or where the direction came from, or whether it had anything to do with the White House. I have no idea. It's just one of those things that just creates more and more uncertainty, and you see the churn of the political chaos. And we're sitting here talking about all of this stuff. and Congress is sitting here talking about, well, I'm not going to even pursue a nomination or a vote on Warsh. And meanwhile, there's other things that, the country should be focusing on, but it's kind of silly stuff like this that unfortunately we're focused on instead of actually, running the country. And that's from Congress's perspective.
I don't know if you've seen, I mean, it's everything has turned so, obsequious, I think is the word. From the reports at Davos, where we had bank CEOs missing their own events in order to wait for Trump, which, I understand that, the president has a busy schedule, but it's unusual for the president not to release people to go to their own events, considering it's a banking event, right? So
Right.
It's an unusual thing. But here's what I find very interesting. So if you've seen the history of this, so Mnuchin took a lot of flack from Trump for for Powell, right? For proposing and backing Powell. And every time Powell did something that Trump didn't like, the rumors and I mean, from printed reports have been that that Mnuchin took a lot of that. Besant was not interested in any of that. And so the reports have been, and I don't know if you've heard anything to the contrary, but the reports have been that he is absolutely agnostic to everything. Whatever you think is what I think. So much so that a report came out today that Besant has said that even though in 2024, he told his own investment firm that tariffs were inflationary, when asked about it today, he then said, no, if that happened, I was mistaken. Tariffs are not inflationary. Has this ever happened before, to your knowledge? Like this kind of...
I'm sure it has.
It contradicts you. I didn't say.
Yeah, no,
I'm
I'm sure it has, and I'm sure that any number of people can get very creative with the wordsmithing that they want to use for, basically catching someone in a contradiction. It's in some ways it's unfortunate, because I know just from financial industry regulation and so forth that, I talk to a lot of people about the fact that there's a pendulum that swings, right? And the pendulum swings far one way, it swings just as far the other way. And I'm concerned that, if one person wants, complete free market regulation, the invisible hand moves markets and so forth, well, that's great. But then when we potentially have a different view in the administration, then the opposite may be true. And so it's a bit of a challenge to look at some of these comments and look at some of these gotcha moments and say, oh yeah, they really got him on that. Like he wasn't being truthful, or he was lying. Was he lying then, or is he lying now? And that kind of stuff. And that's I guess that's part of politics these days, but still a bit concerning from my perspective on a go forward basis, because like I said, it's going to be the opposite in a few years, whether it's this next cycle or the cycle after that. At some point, this pendulum swings back, and I think it could be that the perspective of whoever is elected to the White House in however many years from the Democratic Party or another party, I guess, how far they want to take the same type of approach with respect to how they deal with independence of the Fed, how they deal with their own political favors and disfavors, and how they want to handle Congress.
I don't want to get into the politics necessarily. I just, the idea of a non-independent Fed and these machinations. I want to preface all of this by saying none of this is intended to be political. I have biases. My biases primarily are in that I am not a fan of banks. And I try to preface everything by saying I'm not a fan of banks, so that you know when you listen to me that you can, if you are a fan, you can alter or adjust what you hear in order to account for that. My political view is truly irrelevant right now. And I hope that you take the same from Joseph. Like, we're not trying to discuss politics here, but the independence of the Fed. The independence of the Fed is what's at risk here, because one of the biggest issues is if he is found guilty, not only will Powell face criminal penalties and including jail, fines, and be considered a felon, but also this puts the independence of the Fed at risk. It gives an opening to reconsider the independence of the Fed, and that is something that is already at risk, and is something that is mandatory. And we've seen from central banks, they are highly concerned about maintaining the independence of the Fed. More than the value of the dollar is the independence of the Fed. Our policies regarding the dollar must be independent. That is one of the strongest assets that we have. We have two main assets. One of them is the dollar, but the value of the dollar rests primarily on the independence of the Fed. The fact that it doesn't depend on politics, and that is actually something that I think people don't talk about enough. Is that the independence is mandatory for our continued growth and standing. So I don't know if you have seen anything regarding what central banks are planning should this proceed against Powell. Has there been any discourse that you've actually noticed about that?
There's nothing that I've noticed on the international scale from other central banks with respect to the inquiry into Powell. I imagine that most of them are just kind of monitoring the situation. But at the same time, I would imagine many of them are looking internally and saying, okay, are we as independent as we think we ought to be? And is there something that we need to address for independence purposes? And you're right. We really need the Fed to be independent, because there's never going to be a president that says, yes, go ahead and do what you need to do to fix the economy, no matter what, even if we go into a recession right before I'm supposed to get reelected. No president is ever going to say that. Okay. So the presidents always want to be going into an election with a good job market, a good economy. People are buying homes, people are selling homes, people have plenty of money. The taxes are favorable to whatever way you view they're favorable. But it needs to be that the Fed is independent, so that we can try, or the Fed being we can try to keep things in some level of balance from an economic perspective. That's, I think, the goal of the Fed, or one of the goals of the Fed, and certainly a critical component of what they're tasked with.
So do you know anything about this potential acting chief? Jefferson, I think is his name. Do you know anything about him?
No, not enough to speak intelligently about it. I mean, I've followed a little bit along in the press, but nothing material on him.
I don't really have much either. Which I think is interesting. There's not much at all that I can find on him. And I don't actually know much. I was hoping that maybe you knew something. I haven't heard anything at all. So, if he becomes acting chair, no one cares. Even though that might be the most likely scenario.
That may be exactly what he wants, is that nobody cares.
Like, be the stealth guy.
Yes, yeah, he's on the wings there.
No one will know.
Yeah.
So Powell is likely to actually, it looks like he's likely to remain until his governor term ends in 2028. So even if he's no longer chair, he can still remain until 2028, which would be interesting because he's very influential still. And we'll see, if that actually has any particular impact. Do you see any like conflict coming with that? Or do you think that that's a unique situation, I think, but
I think it's relatively unique. I think it has happened before in the past. I don't think it's been with maybe this amount of perceived hostility, but I think the way that I have ever interacted directly or indirectly with Powell or anybody in his orbit, it seems like he's a relatively even-keeled individual. And so if he says, I want to stay on and still be part of the board and still have a role here because I think that my views are important, I think he'll do that. And I think he'll do that without causing trouble, really. And, to make it very plain, I don't think that's his interest. I think his interest is much more focused on representing the Fed and supporting the economy and so forth. But I guess you never know, and depending on how jaded he becomes after whatever goes on.
So I just want to move now into the discussion of what we think is likely to happen in the future. And so Warsh has some interesting characteristics. He's a hawk, right? So he's traditionally a hawk. But which is that he's not a hawk is someone who is not necessarily jumping to reduce interest to drop interest rates, right? He wants to make sure that inflation doesn't rise. And right now we do have a period of high and rising inflation relative to our goal. It's around 2.7, I think, or 2.8%, and it's rising. Interestingly, there's a couple of really interesting things in the numbers right now. Objectively, our economy is doing very, very well. And the growth compared to, I think we've got something like a 4.5% growth rate, which compared to the same period last year, or 2025. So I did live February to February, was like 2.5% or something like that. So it's insanely better relatively, right? In terms of, we don't know if it's continued growth or if it's continued, if it's just a burst of purchasing and selling relative to the, tariffs and things like that. But it looks like we've had spectacular growth. Our unemployment is growing, but not insanely, right? But the economy feels bad to a lot of people, right? And that is a very interesting dichotomy, is that the economy is doing very well, but it feels particularly bad to a lot of people, which is interesting. And the other interesting thing is what's happening with the dollar is also impacting right now what's going on with the with stocks, right? The stock sell-off. So if you want to, I'd like to talk about that a little bit right now. The two different things. One is the the state of the economy, and the other is the projections for the future. And I know that we're running overtime. If you have a little bit more time, yeah. I'm really sorry. I tried so hard to keep it tight, and I know that it's running long, and I got to work on getting this a little bit down. But I love what you said about uncertainty, because I think uncertainty is really the governing principle of a lot of what's happening right now is uncertainty. We don't know if more tariffs are coming. We don't know if the dollar is debasing or not. We don't know what the policies are going to be. We don't know if we're going to have an independent Fed or not. And the uncertainty is brutal on the economy and on what other countries are doing, because we are the ones that are like the metronome for so many other countries. And when we're uncertain, it makes everyone uncertain. So one of the things that I think is interesting is the fact that the dollar right now. So what I personally am predicting is, the dollar is certainly dropping right now. And one of the reasons why the economy feels bad for so many people, by the way, is that prices are still so high. Prices are high, right? Wages haven't moved. Prices are high. And one of the problems of a frozen job market is it's been a long, long time since people advanced within a company, right? In the US, primarily, we advance by moving companies. You get a higher title and higher pay by moving. You don't get a higher title and pay within your company. That's just not how our system works anymore. So when the job market's frozen, people aren't getting increased pay. And the problem is that ends up in real wages. We end up having frozen wages, but we still have very high prices. So high prices, a frozen market, a very difficult entry into the market, feels like a bad economy, even though the value of the assets in our economy is growing, which I think is fundamentally very difficult. Now, your clients are probably having a great time in this economy.
I mean, well, yes and no. I mean, there's positive aspects to their balance sheets, and there's challenges to the balance sheets. It's not always consistent. And you're right. I'm not going to pretend to be an economist here, but the numbers that come out with respect to the economy, for the most part, have been positive for a long time. And I know, there was a time maybe 6 or 8 months ago when the expectation was that we've got some downturn coming because we've been too positive for too long. Inflation was creeping up, and that really hasn't come to pass. And I've heard any number of arguments as to why that is, including that just the advent and the advancements within AI and technology have kept the tech stocks humming along and making people feel better about the stock market and so forth. I'm not sure exactly what it is, but we have seemed to avoid a downturn for the time being, and hopefully that will continue to be the case for at least the near term. The question is whether or not the uncertainty reaches some tipping point, and we have an event.
Do you know what that tipping point might be?
I don't. I really don't.
Something. I bet we'll know it when we get there.
Yeah. Yeah.
That'll be a bad day.
Yes. And it'll be, I think that tipping point is going to have to be something more than a bad day or a bad couple of days in one set of stocks or one industry, right? So if the tech industry has a bad couple of days, or AI or whatever, I think that's one thing, but I don't know that that's the tipping point. I think the tipping point may be when you see a downturn in consumer staples and tech and real estate, where there's not really an explainable link other than generally things are starting to erode.
So one of the things that Warsh is a fan of is reducing the balance sheet of the Fed, right? So we talked about the Fed balance sheet. One of the issues is if you reduce the balance sheet, right, from 10 to 12% to say 3 to 5%, pushing more money into the economy is that's a form of, quantitative easing. That is one thing that Trump likes, right? More money circulating in the economy, quantitative easing. However, what does that cause? That's inflation.
Yep.
Right? That's inflation. That's inflation right there. Now, one of the things that it does do is give us a big buyer for a lot of this debt. We're issuing a ton of debt, right? We've got another 7 to 8 trillion that we've got to refinance. That's coming up in the next 6 months, and at a not good rate, right? Relative to the 0% of ZERP environment stuff that we have to refinance. that stuff that has to get refinanced, that's going to be ugly refinancing. Now having the Fed available to refinance that will certainly help, especially because of the pressure on these dealer banks who are then available to do private lending, right? So that does give us a relief of pressure so that there's more money available for the private sector. But there isn't any way around it that it creates more inflation. And what does that do? It raises prices, right?
Mm-hmm.
There's inflationary pressure. And what is the problem that people are feeling right now? What is the disconnect that between the very wealthy and everyone else? Is that the very wealthy are not feeling the impact of the increased prices the way everyone else is. This is the biggest problem, is that it solves a lot of problems except for most people, right? It solves a lot of problems that we need to solve. We need more liquidity, but it would be better to solve it in the regulatory sense, right? To say, let's take off those restrictions regarding dealer banks, than to say, let's push a lot more money out and make inflation a problem when pricing is already a problem until pricing can settle back down, right? So my personal feeling is that that particular aspect is going to be problematic, even though that is one of the specific issues where the hawkishness is what Wall Street reacted to and was terrified by, like, oh no, he's somebody who doesn't like, dropping rates. But remember, that's just short-term rates, right? It's this balance sheet that's like, what's the economy of the future? And his view is this quantitative easing, which Trump loves. But that could be problematic because that flooding out of cash is going to be an issue. So, if that happens, we have this problem. We have a fundamental problem of what happens when we have a Fed that has a policy that is generating inflation, but there isn't an engine to deal with the inflation for most people. So the engine to deal with the inflation for most people is our redistribution engine, which is paychecks, right? It's okay to have increasing inflation when paychecks are more than keeping up with the price of things. But if you don't have paychecks keeping up with the price of things, then you have massive discontent. And that's not just an election issue, right? We're an unhappy population right now. I'm not sure that more discontent is something that can really be handled, right? I don't think that we have the political patience right now. Do you have thoughts on what it is like? Is there another valve that could potentially offset this, the tension between inflation and the need to pick up all of this debt slack?
I am not aware of another valve right now that could be used. I think, it's interesting with respect to looking at inflation and the increase in prices. It seems to me that it's even more so an argument in favor of Warsh, because he does have that, or has had that tendency to be a little bit more hawkish. And I think that coupled with his past experience with the Fed and, previously being on the board for a number of years, I think those are all positives for him. And I think they're all positives for the economy. I think, that's not saying that Powell couldn't do it. I just don't think that Powell is viewed as trusted by the administration to be able to do it. And do it meaning like to keep prices relatively steady and balanced, and inflation under control. But with respect to the debt piece, that's a really tricky one. It's a really tricky one with not a lot of great options.
I mean, Santa, Bill Gates, you want to buy some debt?
Yeah, but
We got some debt for sale.
yeah, I know. The numbers don't look good.
Anyone know him? I mean, he likes charity, so
It could be a charity case, yes.
So the next part, and I know you do a lot in digital assets as well, and I wanted to mention this Bitcoin part because there's been a lot of controversy around Warsh's view of Bitcoin and whether or not the Fed would approve a Bitcoin reserve and whether or not Bitcoin would increase. The price would increase if Warsh came on, if Powell stayed. What's going to what kind of thing is going to what is going to impact Bitcoin's price? What's your view right now on Bitcoin's price and the Fed? Like, is there a connection? What's your thought on that?
Honestly, there's a slight connection because Bitcoin is seen as an alternative to legal tender, right? Which is where the Fed comes in with the U.S. dollar and so forth. So there's some level of connection. I don't know if it's as strong a connection as people want to think it is. I think, Bitcoin has become much more of an investment type class than it has really been used for the payments that maybe initially people thought it was going to be used more as, especially in the United States. I think, Bitcoin may be more used for payments and money flow outside the United States. The Bitcoin reserve, I don't think the Fed is, if that comes to pass, I don't think the Fed's going to have any role in it. I think it'll be Treasury that has more of the role on that. But I don't know. The price of Bitcoin has gone down recently. It's volatile. It fluctuates based on folks' perception as to the utility of Bitcoin versus other kinds of digital assets, or whether they think that it's going to, take over as a more dominant, quote unquote, currency. I'd like to think that at this point, people should maybe realize that it's an investment vehicle for the most part. It can be used for payments. It can be used as a form of value transfer. But it's still, from my perspective, it's got a long way to go before it's really entrenched as a form of, really legal tender. There's other use cases for it, certainly, and there's other utility for it. But I don't see it replacing the dollar or the euro, or the yen, or anything else anytime soon.
So, I think that's probably the most common view of Bitcoin, is that it is a store of value, and I think that's very likely that's the safest view of it. Like, I don't think that it doesn't function as currency, right? If it did any exchange, it functions like if you're paying for something like with Apple stock, right? Because you have that secondary level of consideration. If you buy something with cash, right? Your concern in the transaction is, like, let's say I'm buying a computer. This is how I explain it to people, right? If I'm buying a computer with cash, then I only have to be concerned with whether or not the computer works and does what I need it to do. And they have to be concerned with, do I have the cash? If I'm buying it with Apple stock, they have to be concerned with, is the stock going to go down also? And I'm going to have to be concerned with, does the stock go up, right? Am I going to pay too much? And are they going to pay too little, right? That additional level of not just transactional concern, but asset concern. That's how it's not it's an asset, not a currency. So that's the issue we have with Bitcoin, is that Bitcoin is fundamentally an asset, right? It's volatile, and that's part of it's a feature, not a bug.
Right.
But one of the things that I think is fundamentally, and I'm not, I know you know that, right? I'm explaining it because there are people out there who are listening. You've got like almost 300 people, and I'm sure that there are at least 3 out there who are like, I wonder if it's an asset or a currency. So I'm explaining it. So, so the reason I try and mention this is because it is confusing, because you can pay for things with things that aren't cash, and they're still not cash or currency, right? They are still an asset, right? But one of the things about Bitcoin fundamentally is that, remember, it is one of the most liquid things that we have, right? It is, and it's global. So I have noticed that it seems to be a barometer of the comfort, right, and and the disposable income of the middle class, right, around the world, right, with such as it is, because those tend to be the people who have access to it. You have to have access to power. You have to have access to internet. There's a lot of things you have to have access to in order to be able to hold and trade Bitcoin. So there's a minimum standard that you have to have in order to be able to hold and trade Bitcoin. But because it's so liquid, one of the first things that people grab when they need access to something and they don't have cash is Bitcoin. You liquidate your Bitcoin. As much as people here love the idea of hold on to Bitcoin until you die, right? That's not really practical and not how it really functions for most people. So we just have to kind of clarify that it really functions as the immediate source of liquidity for most people that doesn't have the desperation tax on it, right? Doesn't have desperation tax. Mm-hmm. That is why it is so useful, because it does not have desperation tax. It is mandatory, I think, as a human right because of that. But so what is Warsh's view of this? As far as we know, he invests in Bitcoin and Bitcoin adjacent things like Anchorage Digital and other things like that. But he's also just calls it software. Technically, it is soft. I guess it's a kind of software, but he's got a mixed view of it. Does it matter what the Fed thinks about crypto or Bitcoin or anything like that? I don't think so, to be honest. I don't think it matters so much. The value of the dollar, right, does matter, but it really matters to the extent that people feel like they can afford things, right? So more than the value of the dollar is people's comfort in feeling they can afford their lives. I think the price of Bitcoin is a reflection of people's ability to afford their lives in the middle class, right? So I don't really think of it necessarily, because there's not as much institutional pull as people think there is. It's widely held by a lot of people that are like holding Bitcoin and maybe invest in some stocks, but they're also all international people that don't have a lot of access to stock markets. So it's actually much more broadly held, I think, than people understand, right? So yeah. I think the liquidity has a lot more fluidity than people think.
Yeah, I agree. I don't think there's a material direct link between the monetary policy of the United States and the dollar with respect to the price of Bitcoin. I think digital assets more broadly certainly going to impact things like price stability, which is another mandate of the Fed. But I think it's still not a material component of our approach to monetary policy.
So I just wanted to talk about now kind of future thoughts of where we think, like with the dollar, what kind of things are we looking at in terms of the future? Like just general, none of this is tax, legal, investment, or financial advice at all. This is just conversation.
Yeah.
But what kinds of things are you looking at? For the future? Excuse me.
Yeah.
What kinds of things are you looking at in the future? Like, what are you looking at the dollar to do? And what does that mean to you in terms of, the investment outlook?
Yeah. So, the way that I have come to view the dollar, the strength or the weakness of the dollar, is really that it ebbs and flows, and there are direct impacts to the value of the dollar. There are perceived impacts to the value of the dollar, but I don't know that there's anybody that in the United States that is interested in having a weaker U.S. dollar. That said, the dollar value will fluctuate. It will continue to fluctuate as it has, just because economic policy, monetary policy around the world fluctuates as it always has. And so there are going to be times where there's booms and there's going to be times that there are busts. But it's, from my perspective, a little bit of it is kind of a keep calm and carry on type of approach. And a lot of that is really led by, my hope that the folks in the United States that are sitting at the table at the Federal Reserve when they go to do their voting and they go to have their conversations, and they're relying on their economic policy experts and so forth, that they are doing so with their dual mandate in mind, front and center, more so than anything else, whether it's political, personal, digital asset, or otherwise. So I think keep calm and carry on with respect to the value of the dollar. And then with respect to the future, it's really, the future of financial services is changing. It already is changing. It's, because of blockchain technology, because of digital assets, because of, new ways to look at trying to provide financial access and financial stability to other parts of the world where they historically have not had as much success in those areas. I think those things are fundamentally going to change financial services going forward. But the US dollar will strengthen and weaken and strengthen and weaken, and it will continue to be the case.
Yeah, I agree. Like, it does fluctuate a lot, although it has been dropping significantly. And the amount of inflation in that, the big beautiful bill, is extreme, honestly. And depending on the kind of policy we have going forward, the amount of inflation, and I look at inflation as one of our key factors. We have a few factors that we have to look at in terms of, how many dollars does it take to operate your company? How many dollars does it take to run your household, right? How much is that going to fluctuate in the near term versus the far term, right? How predictable is that going to be? And one of the things that that I'm seeing is that the amount of inflation that we have and is embedded in our law is high, and it is unaccounted for, right? And we don't have a measure of reduction of pricing. Here's one of the issues in our in how pricing and inflation works in our society, is that after a period of time, when a price goes up, like because of tariffs or other inflationary measures, after a period of time, that price is reset as the base price. And then we judge inflationary pricing from that point, right? So we're not looking at, burgers at $6 at 5,000% from the 55 cents they originally were, right? Because we reset that base price over and over and over again. And the problem with that is that we're not really looking at how much that base price, that reset base price, has now just been incorporated, but not actually adjusted to wages. That's the problem, is that inflation and wages are glued together, right? Inflation is only irrelevant when wages match it. But what we have now is stagnant and illusory wages, right? Because AI is taking over some positions, And we have also wages that are where people are working more than one job, right? Building wages on multiple jobs. So the problem that we have is wages aren't matching inflation. So the issue that we really have is how are we going to judge, how are we looking at the value of the dollar going forward? Are we just going to continue saying, okay, here's our new base rate and it's fine? You know, like in a year, we're just going to call everything, we're back to zero. It's fine. Or are we going to say, you know what? We still haven't reset from 2000. We're still feeling all of this stuff from 2000. We're not actually accounting for the fact that our wages are from 2000, but you know, our prices are now this much, much higher, right? So we have to find another measurement. The next thing is, if that means that fundamentally dollars right now are worth significantly less, but we're pretending that they're not. We just keep recalibrating to say now they're worth more, or now they're worth this, and it's fine. We have to stop doing that, right? We have to carry forward our inflationary price changes. We have to carry those forward instead of reset those all the time. The second thing is the value of the dollar is actually declining because of this idea of trying to make the US into a manufacturing headquarters, which will not work. I'm not even going to go into it. It's just not going to work. We don't have the ability. Just not going to happen. Will not happen. Won't happen. Okay. Not happening. But that is actually something that is they're trying to do, is reduce the value of the dollar. And the pressure is also coming from the sell-off from BRICS. BRICS is selling a lot of the treasury bills. What does that mean? When dollars are cheaper, things priced in dollars are worth more, right? You can buy more of things that are priced in dollars. That is why metals and things like that have been going up. When do they drop? When the price of the thing that was the engine of that trade starts going up again, right? The price of dollars has been dropping, and that's part of what started driving the engine of the gold, silver, platinum trade. But there was a sharp spike in the dollar, and that started to drop the gold and silver trade. The price of the dollar is not going to continually raise, right? So these are the things that you have to look at, is what is the relationship between the value of the dollar and some of these things that you invest in, right? If, for example, the value of the like short-term interest rates being low is what is driving stock prices higher in certain areas because they need to borrow cheap cash, and then short-term interest rates go up, those stock prices are going to drop, right? So this is a lot of what I talk about in my newsletter personally. And this is a lot of like what my company talks, like we do this for our community in Populous. If you're interested, by the way, just go to populous.co. That's where we could talk about more about that. I'm not pushing that right now, but that's a lot of what we talk about in detail. I know, don't smirk, but that's what we're talking about. Is we do a lot of this, is this like, and I go into a lot more detail about it, is like, let's break down exactly how this happens. Like, let's look at the news, and then let's look at what that news means. And then how does that turn into an investment decision? Because I think that there's this huge gap between news and investment decision, and people don't really make that connection. And that is the big problem that I'm always looking to solve, which is how do we go from like, here's an event that happened, and then all these things happen in the market, and people don't understand, like, well, how do you know what to do? But just understanding, well, here's the loop of things. And so in just one area, the loop here is that if the dollar goes down, things that you pay for in dollars, look for hard assets that are paid for in dollars. They become cheaper because you buy them in dollars. It's like, you go to another country where it's super cheap there, and you buy a ton of stuff like alcohol or whatever, and you buy a ton of it because it's like super cheap because you're paying in dollars, like that kind of thing. Like, it's like that. That's what you're doing. So that's what's happening a lot. So you have to understand what's driving those investment transactions. So anyway, I'm not going to go into more detail here. I just want to try and clarify things because I think it's really important for people to understand this kind of thing. This is not because investments don't happen with secrets. It's not about the frozen concentrated orange juice thing, it's not a bunch of secrets in like a room with like a bunch of, fat white men with cigars, this is the next big deal. That's not how investments are made. It's really just about people who understand information better than the rest of the market. That's really it, right? So that's really all it is trying to understand information better than the rest of the market. So anyway, we've taken up so much more of your time than I ever intended to. Joseph, please don't hate me and please come back.
No, anytime. Not a problem.
I'll be like, oh my God, she promised me like an hour and it turned into 2. And the people just kept coming. So I'm just so honored that people just kept coming and listening. But I hope that this was great for everyone and informational. And you guys learned stuff. Joseph, what would you like to say about anything?
It's complicated. Things are complicated. I appreciate the commenter that asked for more on quantitative easing. I think that would be at least a full day session. But it's, the way that the markets work, the way that the dollars work, and the strength of the dollar fluctuates over time on an international scale is very complex, and it does take time to understand it. But Alexandra, you're absolutely right. It is important to understand how that impacts things like prices and inflation and how these things kind of weave together. And then how you then get individual personalities, political perspectives, and internationally political perspectives as well involved in the conversation. It always turns out to be just a little more complex than anybody really wants it to be, but that's the way the system is right now, and that's how it's kind of developed. So, for better or worse, it's a complex system.
Totally true. It is and it's Byzantine to understand, right? I mean, it is. Man, all the people who are like, just come up with one sentence. You try. Yeah. Like you first, or whatever. Well, go ahead.
Yeah, no, I couldn't come up with one sentence if you gave me a year to do it.
Tell people where to reach you.
Okay, so I'm kind of all over in different categories of social media. You can find me on LinkedIn, clearly. You can find the podcast Money and Banking Law on the Duane Morris website. All of my contact information is publicly available on the Duane Morris website, just duanemorris.com. I'm in the Chicago office of the firm, and happy to help out any way I can. You can find me, like I said, on LinkedIn. Podcast is available wherever you get your podcasts. I'm working on some video options as we speak. It's a relatively newly released podcast, so working on that. And you can find me on Telegram. It's @UnicornLawyer. On X, it's Bank Counselor. So wherever you social, just let me know. I'm happy to connect.
I wish I knew how to edit this so that I could actually put it. But so Duane Morris is DuaneMorris.com. It's a major law firm, and it's very well known. So it's an easy way to get him. If you want to contact me, you can just reach out to populis.co, populis.co. That's where you can find me. So I wish I could, like, next time I'll try and figure out how to put the name underneath, like the, contact information underneath. This is my second live stream ever and my first multi-stream. So, I think we did great.
We got to figure it out. We got to figure it out.
I got to figure it out. So next time we'll have it together.
Yes.
Anyway, thank you so much. I really appreciate it. Thanks to everyone for joining us. And I will see you next week for another economics and markets report. So take care.